So I hope everything is going well for you. We have very interesting things in the markets. One of them is the gold market, which we had set a forecast into motion. Gold was, the forecast was made 2 days ago that if they could close above $1,920, which they did, they closed at $1,921.50, you could buy gold for an advance to $1,957 and then $1,977. And today we've made a high of $1,967. So a lot of it has been completed. We've exited, we've exited our trade officially because we're close enough. We're happy with the results, even though we know that there's potentially more coming. We felt that it was just, we gotten the goodness out of the deal. You know, I mean, for many people, pretty close to 70 points. Excuse me, just one moment. So that is where we are right now. The gold market, I'll put that out on Twitter, and just a little later after we see what happens, this will take us into tomorrow. And several other important things are happening in the S&P. Let's take a quick look at the S&P as well. So the S&P is kind of in a very interesting and critical position, and here's why. That I don't mind telling you that normally this correction that the S&P is in would normally last a little bit longer than tomorrow. And therefore, if this market is going to do something like break out prior to tomorrow, or even tomorrow to the upside with an actual confirmed breakout, that's a peculiarly strong position for the market to be in under the conditions that exist right now in the market. And if that's the case, then that could indicate tremendously higher prices coming. So keep that in mind. Ordinarily, that's not going to be the case, but we are, you know, coming into a very important week with a lot of volatility, which is the week of March 20. Let me just make sure I have this correct. Yeah, March 28th, which is Monday. So it's really interesting what they're doing here. Here's the hourly chart of the S&P. Still very strong, acting very well here in spite of earlier pullbacks and so on. So we're going to be very interested to see how this plays out. Now, because of this, again, today I don't have a ton of time for this meeting because we want to be positioned properly, and just in case we do get up to certain important levels on the upside, we do want to take action, and we want to do all the things that we normally do. I'm sure you would probably do those things or have certain things that you would want to do at certain conditions as well. So because of that, I'd love to have the some questions from you, or some anything that you'd like to talk about. Maybe you want me to talk about something, or maybe you want to ask a question, or maybe you want to say something. So please do that. Rob is here and he says, how about the soybeans? Thank you. Yeah, let's take a quick look at the soybeans today. We felt that soybeans yesterday and into today could have moved a little bit higher than they did. And so I have a little work to do on soybeans to see if this really indicates authentic weakness in the market or not, like today's decline, whether this really means, you know, wow, the market's going to really be coming down hard or not. And if it's not that, then great. But if it is that, then we have a larger forecast into May for what we think soybeans would do. Now, I have some work to do on all of this today to be sure about it. I mean, I just really, again, want to show everybody, this is the yearly chart of soybeans. So that's a big picture view. Here is a semi-annual chart. Many of you won't be able to get a semi-annual chart on your thing. Here's a quarterly chart. Those of you that are foolish enough to be using TradeStation will not be able to get a quarterly chart for God knows what reason, but you're not able to get one on your chart, making your platform utterly worthless. Then here is a monthly chart. This is particularly important, the way they've handled themselves. This has been a super powerful advance. This is the weekly chart of soybeans, as you can see. So they still look pretty good in the bigger picture and the medium picture. And then this is the daily chart of soybeans here. So a lot has happened. It's in a very interesting position here, but I have some work to do on this to be able to really understand its real true position. Just because a market is advancing doesn't mean it's actually strong. It can and often is an advance that is counter trend to what the market really wants to do. So when we talk about knowing the true position of the market, we mean what the market really is going to do here, even though it might be advancing. Maybe it's going to go down, or the opposite, if the market was really in an uptrend. So a lot of the things you've read in books that say, trade with the trend, that's a good idea. Those are, in my opinion, that's a good thing. The question is, can you determine the trend of the market? And we can say, it can be said that the market could be in a downtrend on a daily chart, but it could be on a uptrend trend on an hourly chart. It would be very helpful for you to know how the hourly relates to the daily, so that you could know whether or not you would like to be long on the hourly indication, in spite of the fact that the daily indication is actually down. See, so understanding what the trend is a big part of then being able to say, I'm trading with the trend. I mean, if you wanted to reduce it down to, elementary school levels, you could say, well, the market is moving up on a 5-minute chart, therefore the trend is up. And if I buy it, I'm buying with the trend. That's not really what we're addressing here. What we're addressing is understanding that a larger trend has not yet fulfilled its move, and it's still underway, in spite of the fact that perhaps the shorter term trend happens to be counter to that for a temporary period of time. Do you want to be long for that counter trend move, or would you rather just be short at critical levels, hold and maintain for the reassertion of that downtrend from the longer term chart? So those are things to think about, because again, as I've mentioned, the people that trade on tick charts and 5-minute charts, 2-minute charts, 1-minute charts, in many cases, they're not even knowledgeable. They're not even understanding what the larger trend is and which of those larger trends are really in charge ad nauseum. They're not aware of that, nor do they care. So it's not going to be easy to be successful. It's already hard enough, right? But you make it much harder by not understanding that. So there are things that have been written in books that, in my opinion, are spot on, right on. You do want to trade with the larger trend, or sometimes they just say trade with the trend, but they don't make a real distinction about what the trend is and how to determine what the trend is. And if you can't determine it, then it may not be a good idea to be trading until you can. And in many cases, the market may not even be in a trend. It might legitimately be in a sideways motion for some period of time. And then you would want to trade much smaller and so on, and not too aggressively. When the trend really is underway and the market wants to move from that trend to a particular important level, like a square or some other target, and it hasn't yet reached it, you do want to view all of the counter trend moves through the viewpoint that those are counter trend, and that the daily or whatever the larger time frame is hasn't yet completed itself. One other thing that traders rarely, if ever, and this includes all of you, rarely, if ever, have thought about is the drastic and dramatic difference between timescales that are widely accepted scales. So as an example, a 1-minute chart is a widely accepted time frame, but so is a 60. A 60-minute chart, this is what most people have never really sat down to really get the impact of this. A 60-minute chart is 60 times the size of a 1-minute chart. 60 times. That's just almost unfathomable. A monthly chart is 21 or 22 times the size of a daily chart. So why would it be important for you to meditate on the scale difference between time frames so that you can start to understand what these larger forces are capable of doing, since they're 22 times larger or 60 times larger than other commonly accepted timescales? So if you would go through it, I would suggest that you go through that and go, just like I'm telling you, from the 1 minute to a 15 or to a 30 and 60, and then go from, say, well, there's each day has, say, effectively 7 hours in it. That means that a monthly chart is 154 times the size of your hourly chart and its indications. That's unfathomable. Don't just say the number, well, it's 154 times. No, really get it in your head that how incredibly huge it is. What if somebody said to you, well, I'm going to take your current net worth and I'm going to increase it by 152? That's pretty good, because if you only had $1,000 to your name, that would mean that you now have 152,000. Well, get that scale in your mind with regard to the time frames, so that you can recognize that the market really can have dramatically larger moves than you would be expecting if you don't recognize how much these larger time frames represent in force over the time frames that you might be very comfortable trading on. Keep that in mind. So thank you. Rob Connie's here, and he says, any weekly or monthly top in the S&P coming? Well, we have a forecast, Connie, that it's difficult for me to answer that question, because you are denoting weekly or monthly. The only important top that's on its way but has not yet occurred is a weekly top. And that weekly top would require the market, would require more time to pass and more price to occur on the upside. So then we would get to the point where we have a weekly top. We are actually forecasting that the market will continue up in spite of any current daily pullback that we may be talking about being the normal posture. We are forecasting that we're going to be moving up to a weekly reflected wave top, and that will be a super important place for the market at that time. So that's the only one. And then we also, just in February, as I know you know, we put in a monthly reflected wave bottom. So the market is moving off that bottom. And again, given the conversation I just gave you about timescales and how radically different they are from commonly traded ones, and how virtually nobody has given any thought to what I've said about the differences between those, and that you should understand and appreciate those differences so that you can do better in your understanding of what markets are likely going to do. That monthly bottom is quite sizable. That's a pretty sizable bottom, and it has a lot of implications for the upside. If you say to me, well, the news in the world's really bad, you've got Russia, Ukraine, you've got the current administration, you've got all these other things that are going sideways, inflation, that's all true, but all of that has been priced into the market. So priced in, meaning that those have been accepted and the market has traded those to levels that reflect people's current outlook, including all of the things that people know. Like, take as an example, Ukraine. Well, Ukraine has had the hell bombed out of it by Russia and by Putin, who by all accounts could very well just be a madman, even though he's willing to supposedly have negotiations and so on. He's trying to do certain things that he feels he needs to do. And people have made arguments that, we would be in a war if the things that had happened to us that had happened to him had happened to us, and so on. I'm not so sure that's necessarily the case, but either way, pretty much all future outcomes of Ukraine have probably been pretty much priced into the market. All future surprises, foreseeable surprises, have been priced into the market already. So Ukraine is kind of off the charts right now because it's already been priced in, and therefore the market could be in a very strong position. And I'm actually suggesting that it is, in spite of shorter term pullbacks and so on. So we have forecasts for the S&P. I won't go into details here, to be higher, and how long that higher will go. So I hope that helps, Connie. Stu is here and he says, hi, David, any tops completed in gold on daily or weekly bar other than what you said earlier about 1957? Well, 1957 and 77. Those are the two targets that we gave out a couple of days ago for gold to move up to, and we're waiting into tomorrow to see if they can complete that that level. They got to 67 today, and we've taken our position off. I don't know if there's a daily reflected wave top that has been triggered. I don't think so right now in gold, but I am interested in the next move, and we're going to be working on that after the close today. What is the next move for gold if we can work it out? Gold could go quite a bit further than our original target. It hasn't even reached the 75 to 77, 1975 to 1977 as yet. But there is some possibility that it could go substantially beyond that. We first have to work out if that is going to happen or not, and then we'll go from there. So you may ask me about that tomorrow. We'll talk a little more. Thank you, Stu. Samuel's here and he says, does that mean you no longer see an annual top in the S&P this year? No, I still see it's actually a semi-annual top this year. And it is, in fact, let's put that chart up just for giggles here. So again, this is the semi-annual chart. And this was officially the last 6 months of last year, we were saying was the top. And it did actually, but our forecast was that if they did exceed it, they wouldn't be able to sustain it. They did exceed it by 8 points, and then they had a big decline. So that's nice. But we're not forecasting new highs in the S&P, but we are forecasting, and I can't go into details here, a further advance from current prices, generally speaking, current prices, a further advance, and the timing for that advance. And it's pretty interesting. I mean, I'll give it all to you if you take a trial or come in and subscribe. But it is, with everything else being priced in, the market's actually in a position for a pretty sizable move. So just keep that in mind. We haven't changed our forecast for the 6-month top, but we are forecasting a pretty important move. So leave that as it may. Timothy's here. Hi, Timothy says, I expected further down today from yesterday based on certain reflected wave indication, but so far that has not happened. So are you factoring that into a possible strong bull continuation? Well, normally, like I said at the start of this, we wouldn't just break out of 45.14 to 16, say today or tomorrow. That normally would not happen. If it does happen, the market's going to move quickly up to substantially higher levels. And I've given those out in the meetings today. It's not normal for that, but sometimes the market is not in a normal position and it can do something like that. And if it does, you can't be on the wrong side of it. If you have, I'm not talking about you personally, but if a person has the bad habit of just holding on to losing positions, he's going to be hurt by that. So it gets, one thing about the use of stops and the use of protecting your capital and so on. people are not comfortable taking losses. As a matter of fact, people seem to be, and I include myself in this, people seem to be more comfortable holding on to something that's losing with the assurance that with the hope that the market will come back than they are in limiting the amount of loss overall. People seem more comfortable with leaning on hope that something will recover and sitting through whatever it is going to do until it does recover. They seem more comfortable with that than with simply saying, here is a fixed dollar amount, or here is a dollar amount or a position that this stop has to be in, so that I don't lose any more money than that and I can reposition, reassess, and so on. It probably takes time for people, I think it does take time for people to learn how to lose. Everyone's trying to learn how to, what they call, win in the market, and it's not winning at all. It's understanding what the market's likely going to do and being correct about it. So you win prizes and you win when you're gambling. This isn't that. I know you know that. But having said that, people are comfortable with that. If you're not comfortable, if you're the type that, or if you're currently, not the type, but if you're currently a person who would rather hold on to a losing position because the market generally comes back and will make you whole again, that only works for so long, and then you get stuck in a position and wipe everything off the table, right? We've all been through that, right? So it isn't a workable, viable strategy to hold on and hope, even though it does work. In fact, in many cases, it does work. On the other hand, if you just simply say, listen, as bad as I feel the market's going to come back, it's in a position that it shouldn't be in, and it's pressing for further, I don't want to let my loss get any bigger than this amount. Let's just say you have like a catastrophic loss. If you just honored that catastrophic loss, it is over. It does hurt because no amount of hope will bring it back now. Even if the market goes back, you'll be kicking yourself probably. But what you get in return for throwing away the hope that it'll come back is the fact that your loss isn't going to eat up all of your previous gains. That's the beauty of limiting your loss, is that it doesn't eat all of your earlier gains alive. There are people who trade in options. We do. And where we, sell option premium against a stock that's making a high or a stock that's making a low. And in options trading, you can have 10 or 12. Often it seems easier to have, consistent looking gains, but sometimes that's because people just hold on to options as the market goes against them and so on, and then the market comes back. But in options, if you let the position go against you too far, it's very easy for it to wipe out all of your previous gains. People tend to think of gains in this way, and I'm right in there with you, but I've learned to think differently. The consistency and number of trades that are correct are the whole way that people think about it. But the amount you make on winning trades and the amount you lose on losing trades are much less thought about. So there really is something to limiting to a catastrophic loss type thing. Let's say you trade in the micro E-mini contract, and the micro, if it moves 20 points against you, it might only be $100. And you would say, well, that's only $100, so I can certainly live with that. But forget the dollar amount, it's 20 points. So if you were trading in the regular E-mini, that would be $1,000. You have to come up with a number that is a catastrophic thing, that if they get there, you just have to get out. And it does hurt, and you no longer have any hope of being made whole. But in return for that, you're not throwing away previous trades. You're not going to lose all of your previous gains, which are it's very easy for people to do that. In fact, I would say that that is one of the most common things that happens to traders. They have a series of wins, series of gains. They're very happy about it. They step in, it's just a normal day, they put a trade on, the market goes against them, but then it keeps going against them. Before you know it, they're in trouble. Now they don't want to get out. They're not at all in the mood. They were in the mood to have another gain. They're not in the mood to have something 35, 40 points against them. Before you know it, it keeps pressing. It gaps down the next day. And now they've taken back all their last, the last 10 or 12 trades, or maybe all of their trades. And they lose. So there is a real advantage to just having a limit to your loss, something to seriously consider about. So anyway, yeah, Tim, you were saying you're expecting some further down today. We are still in that camp into some near future. I won't give you the date here. And like I said, if we do end up breaking out, I'm not forecasting that we will, but if we do, it is going to run very quickly to distant targets. That's what got me into this conversation with you about this. So we'll leave it at that. Thanks. Connie's here, and Connie says, he says he'll have a top at 45.78. So very good, Connie. Appreciate that. We'll keep an eye out for that. Timothy's here, and he says, will, however, the market handles the coming weekly top confirm your far away third? Well, I don't want to give that information out here, Timothy, right at this time. The one that we have people paying for. So, if they pay for it, I want them to be the ones getting that, not just everybody else. But I am pretty lenient with some other stuff here from time to time, just to help out. So I can't really answer that here at this time. So here we are on the S&P at the 60-minute chart basis. So yeah, once you have taken that step and have gotten out of a losing position, and yes, it's your catastrophic stop, and maybe it's $100, and that's nothing really, but it is 20 points. And let's say you get out, now your head can start to clear as soon as you get over the feeling that you maybe should have stayed in, and all the other stuff that people are going to do. What the hell am I looking at here? Let me get this up. This is the S&P. You then start having some more clarity in your mind, and you're able to think clearer and start putting positions on it. It's very easy. It's not that difficult to make 20 points in the market, and you stopped yourself from being at risk. You might even be able to reverse at some point and take a trade to the downside. The market was pushing against you. So there's a lot that we can say about, the learning how to lose. Everyone's trying to learn how to gain, but there is something to be said about learning how to lose, because it goes against your emotions. And ever since all of us have been raised, everyone tells you, fight, 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 never give up, that whole thing. Well, there may be some real wisdom in giving up on a particular position so that you can fight, fight, fight to keep your capital and raise your capital and gains and all that. So don't turn it into a junior high school game of I'm always right. That's what people do. And particularly men. Men are particularly bad at junior high school antics in markets. I can include myself in that. Not so much anymore, but I've been through it. And I know some of you have moved up the trader's mountain somewhat as well with this. You have to learn how to lose properly when, so you can fight another day and so on. All right, so I think that's everything that I have. Here's a 15-minute chart of the S&P. They just spiked up to 44.9750, and they've pulled back here. We'll see what they're able to do. I think that's all I have for today, but I will be here tomorrow. Let me see if you have anything else for me here. I don't have a ton of time left, but let's see. Stu says, since you mentioned that the ES will make a semi-annual high first half of 2022, it already did, yes. Is it on time or one bar late, and would a spike above it in the second half negate it? It wouldn't negate it if they spiked above it in the second half. Only closing above it on the same time frame that the top was created on would potentially negate it. So, and again, the forecast that we have is, I think, a pretty interesting one for a good part of this year. So, what we think the market is going to do and what we've worked out, maybe that's a better way of saying what we have worked out that the market's likely going to do for the rest of this year, even though, and I don't mind saying that it is in a more bullish than bearish position. But every time the market goes down, like if it were to go down in the next, short-term time period here, as we think would be more normal for it, if that was going to happen, it's very important how they handle themselves on that decline to further indicate whether our larger forecast is correct. So that's something that is a very common practice with me that you also will not read in any books. The practice of watching how the market handles downside targets that are meant to occur at a specific point in time, since most people haven't put that type of strategy to work or have that understanding to do that. During the period that the market is completing those prices, which we forecast all the time, that's a really important time to see how the market's handling itself, whether it's very buoyant on that particular point in time or whether it's above it. A good example of what that might look like is the market coming down to a point, say right here, and this is the on-time bar for them to be there in time. This is the on-time bar, and this is the price. If they came down and didn't touch quite, they just got really close and then turned up, this is one of the strongest positions because they bottomed 1 unit early and they couldn't quite touch the price. That's very strong. And there's variances about how other ways that they could do it, but I'm just giving you an example of how the market can show strength, but only if you know that this is what the market is trying to do. Then you can then say, well, it came in 1 unit early and it was light on touching it. It missed it by 3 ticks, and now we're moving up. That's a very strong position for the market. That means that there's a tremendous amount of buoyancy in the market, and that buoyancy is pushing the market up. Even while it's going down, there's a stronger than normal force pushing up. You didn't know that. You didn't read that in books, but that's what's happening. The market, while going down, is buoyant because a larger force is still resident, getting ready to express itself to the upside. So if we see that type of action or other variances on this, we can know or surmise that our larger forecast is still correct. So that's just an example of how these things can work out and how you can read what the market is likely going to do under a given set of conditions. So everybody is going to end up, no matter what it is, everyone's going to end up with their own way of perceiving and trading. And there really is no perfect right way. There just is understanding about the market or a lack of understanding about the market. And everyone can understand, and everyone can, therefore, put that understanding to work. Everyone understands that they have to drive their car a certain way, and everybody perceives things differently. But for the most part, everybody drives their car the way they're supposed to, even though they perceive things differently than you and I do. So it doesn't really matter that we perceive things differently. What matters is that we have understanding. Understanding trumps perceiving. So everybody who perceives things slightly differently can get into a car and drive down the road, and they still, through their own perceptions, figure it all out. Because not everybody's seeing everything that you think you're seeing, and other people are seeing things that you may not be seeing, and so on, because of the fact that they emphasize and de-emphasize things in their field of vision differently, and so on. But in spite of all that, everyone can drive a car by understanding how to drive and forces and all that, and be able to do it. That's what it's like with markets. So you don't have to be me, and I don't have to be you. You just have to have an understanding. And that's what we're all working towards, is an understanding. It has nothing to do with money. It has everything to do with understanding the nature of the market. And then once you can make some money, then it can be about money for that particular trade. And then you go back to understanding the market. And then if that works and you make money, then it can be about money for that trade. And then if you take a trade and it doesn't work out and you've limited your loss, you can feel good for the fact that you protected your capital instead of falling for the loser's game of constantly hoping the market's going to come back, because it often does. Those are losing strategies that feel good. Sometimes winning strategies don't feel so good, and yet you win. See, that's where people go off. They just don't want to feel that way, even though it works. So check that out for yourself. If maybe you're doing something in the market that really ends up being a losing thing to do, but instead of going the other way, you just don't like the uncomfortable feeling. Maybe you could get past that uncomfortable feeling and feel really good about doing the right thing. That's what happens. We've all been there. I'm just suggesting this is something for you to think about. So anyway, listen, thanks so much for coming today. I hope some of that is useful for you. We'll be back tomorrow for our Friday edition. I hope you can be here. There's some possibility it could be very busy tomorrow. We may not be able to have the meeting, but I hope we can, and I hope I can be here. But if not, we'll be back on Monday. And I want to thank all of you for coming. Stay well. I'll see you tomorrow. Thanks again. Bye-bye.